we've had a good couple weeks in silver. That party is just getting started. So I think silver can, and my long-held target is 60. I think that can be seen, if not by the end of this year, and I think it very well could be by the end of this year, the early next.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend David Hunter, a contrarian macro strategist with over 50 years experience on Wall Street. David, thank you so much for joining us today.
Yeah, hi Elijah, great to see you.
Well, it's great to have you back on again. You've been calling for a melt up for quite a while now, and this is based on your research of pretty much a 40-year trend, kind of what we've been seeing in the stock market over the last 40 years. And now this is coming to an end. We're going to, as you say, have this last melt up. So the stocks are going to go parabolic. Pretty much all assets are going to increase at the same time. And then we're going to see this huge crash. And a lot of people back in 2022 were thinking that was the beginning of the crash. And you were continuing to say, nope, that's not it. We're going to see even higher highs, and we're going to see a final parabolic move and a top for the stock market, for precious metals. Your perspective on what we're seeing right now, because it seems like what you've been talking about for quite a while is finally playing out.
Yeah, I think it is. I think we're coming to the last phase of a 41-year, what will be close to a 42-year secular bull market that started back in August of 1982. Disinflation drove that cycle, and then we've obviously had in this last few years the breakout of inflation and having to go through the tightening cycle, et cetera. And back, as you say, back in 2022, people got very bearish, and we're talking about S&P down to 3,000 or below, and maybe much below 3,000. And although I see that coming, I didn't feel that was the time for it, and I felt we would get through this tightening cycle and have one more push to the upside before this market topped out. And that in spades is what I think we're seeing. The S&P is up 50% from the October 2022 lows. The NASDAQ's up over 60% in that time. You're seeing the Russell finally begin to join the crowd. The Dow's up pretty good, not as much as the other two, but doing pretty well. And you're starting to see a broadening of the market, which I've been calling for quite a while. Well, most people were saying this is a low-quality rally because it's led by the Magnificent Seven and not much else. And I said, you really have to kind of open your eyes and look beyond the narrative and realize that there's been other groups along the way. I mean, home builders have doubled since October 2022. And, semiconductors have obviously been a huge winner in that time. So, there were other groups, industrials, et cetera, that have come along. But now you're seeing even a broadening from there to the materials and to the financials, and lots more of the tech area I think will play. So it looks to me like a market that has a long ways to run here. My targets on the S&P is 7,000, NASDAQ 23,000, the Dow 55,000, and the Russell 2,000, I think, can get up to 3,300. And I am beginning to think those numbers may prove conservative. They're certainly a long ways from here, so I'm not raising targets or saying they will exceed that. But I think it's a high conviction call for me that we have a big run still ahead. And frankly, we just had a short consolidation in the markets. One in the first half of March, then we kind of had a little rally and then another consolidation recently. And it looks to me like the market's coming out of that short consolidation, and you're about to see another run here. So I know a lot of people who have been bearish all the way up have joined the bull party and say, yeah, I agree. It's broken, the market's to new highs. I think I'm more bullish, but I need to see this thing correct, and then maybe it can go. I don't think you're going to get that opportunity. I think this thing's going to just kind of have these short little pauses that refresh and then just go again. Now, somewhere in here, you could have a bigger pullback, but I don't think that's here.
Now, as for precious metals, what are your targets on that? I know gold has been moving quite dramatically, and just this week, silver has been catching up a bit with the gold-silver ratio falling. Gold is breaking, 2,300, and silver is about 27 right now.
Yeah, amazingly, I mean, gold had basically a triple top, maybe even a quadruple top there before it broke out. Started back in 2020. It ran up to the high 2000 area, went back down, came back up in 21 and again in 22. And we're finally breaking through to new highs. And once it broke out, you started seeing people kind of jump on the bandwagon. So you've got legs there. My target on gold is 3,000 this year. What I call pre-bust. Doesn't have to coincide with the top of the equity market, but I think it's likely to be this year. And it's a short-term move. And I think we're going to see pauses along the way, but generally you had your consolidation, so don't sit around looking for another one, because I think this thing is, you're just getting started. And silver, which has, gold's at new all-time highs, obviously. Silver's a long ways from its old highs and has been the laggard for a long time. As you say, the gold-silver ratio is up, was up at 89, I think, and is just starting to come back down. We've had a good couple of weeks in silver. And I think there's that party is just getting started. So I think silver can, and my long-held target is 60. I think that can be seen, if not by the end of this year, and I think it very well could be by the end of this year, be early next. So, 60, and I've said recently, if it breaks 60, you could run to 75 very quickly. So 60 is still my target, but I wouldn't be surprised if that's low. That's a long way. I mean, silver's, just been in the kind of low 20s range for quite a while. Finally has moved up to 27, and I think could move very quickly to the mid 30s and then maybe pause and run again, or certainly move up into the low 30s and pause and run again. So, you're going to have, I think, a lot of upside in the miners as a result of this. And I think investors who have been kind of disillusioned by particularly silver, but by the miners, because it took so long, a lot of those that were bullish and expected these breakouts before have kind of thrown in the towel. It's taking them a while to believe this rally, because I think, I've seen this before, I'm not buying it. And so it's, that's how healthy skepticism that will keep these things running.
If we're not going to see pullbacks from here that are dramatic in gold and silver, how do people position themselves? Obviously, we can't give financial advice, but it sounds like these days of, like $22 silver or under $2,000 gold are probably over.
Yeah, I think in the bust, as I say, there's going to be a melt up in the equity markets, and then a bear market following that will be accompanied by a global bust, which is a big financial crisis and economic downturn. In the bust, you could see, let's say I'm right about the 3,000 target on gold. There's nothing that says it can't come back here. So gold could go from 3,000 back to 20, 21 or 200, or which was back to the breakout point basically. And there's no magic to my target that it couldn't, it certainly could be exceeded. So you might be 33 or 4 or 500 before it stops and then comes back, and it may not come back as far. Who knows? Silver is going to be the more volatile metal. If it goes to 60, I doubt that it comes all the way back to the low 20s, but it could. If the stock market's going to drop 80%, there's nothing that says silver can't drop by 60% or 70%. So, it's a much more economically sensitive and volatile metal. So there may be another opportunity in the bust, but between now and my targets, I think you're not going to get these kind of opportunities again. They'll pause. Silver can have can go to 35 or 6 and then back to 30, or gold can go to 2,500 back to 2,350. I don't know what the path's going to be exactly, but trying to guess that is difficult. And when there's so much upside, it's like, this thing is, I want to reemphasize, I think this thing is just getting started.
What kind of historical precedence is there for this, where we're seeing the stock market and gold rise at the same time? It seems like a lot of people have this idea that the stock market is reverse gold and gold is reverse the stock market. But right now, we're just seeing them rise up together.
Yeah, I see this a lot in the markets. Is people kind of have recency bias, whatever they remember as the most recent actions, or they think that's forever, or that's always going to happen. We've had times when the metals go with the market, and times when they are very much counter to the market. If you look at the first decade of this century, from 2001 to 2011, we had a huge bull run. And that was also a time when we had pretty good stock market during periods of that time. So there have been times like this when the stock market can be going up and the metals can be going up at the same time. So I had that question a lot when I was bullish, when everybody was bearish, and they said, they're not going to go up together. And I said, I think they are. And so I think you have to step back and realize that there's no one formula for these things. Sometimes they move with the market, and I think this is one of those times.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 1st through April 8th, 2024, while supplies last. First, we feature 2023 1-ounce Silver Krugerrands at $3.10 over spot. We also have backdated 1/10-ounce gold Canadian maples at $35 over melt with a minimum order of 4. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
And for those who aren't looking to really trade the market, get in and out real fast, what do you anticipate the next decade looking like? It seems like we've had for the last 40 years, as you mentioned, this bull market in equities, and people can just buy and hold. Do you see that fundamentally changing going forward for the next 10 or 20 years?
Very much. I have been on record as saying that the highs in the stock market this year, and as I say, I think 7,000 on the S&P is my target. If we reach that high, or whatever high we reach this year, and if that's the secular top I'm calling for, I don't believe we'll get back to those highs or anything close to those highs again in the next couple decades, and maybe longer. This is a major final thrust into a top. And the reason for that is because first, we're going to have this 80% bear market in the global bust. Global bust is something I don't people hear the name, the term, but I don't think they really understand how significant that is. It's nothing like what they've lived with in post-World War II era. It's going to be a short-lived, I think, relatively short-lived, 12 or 18 months. But you're going to be wondering what's coming out of that because it's, bank failures, it's a lot of things. So it's 2008-9 was kind of a precursor to it. So you got a pretty good taste of what a financial crisis looks like. This one, I think, is going to be worse. But coming out the other side of that, because the central banks are going to have to respond so aggressively to that bust, the printing of money to a degree we've never seen in this world. And 2020 was beyond anything we'd ever seen. This will be 4 or 5 times that. Will trigger an inflation cycle in the post-bust era, meaning 2026 and beyond, and could culminate in inflation getting up as high as 25% in this country by the end of the decade or early next decade. If that's the case, that really shrinks PE multiples, market multiples. Stocks are very interest sensitive, and if interest rates are going down as they were the last 40 years, generally trending down, it boosts price earnings multiples. It boosts the market multiple tremendously. You get the reverse of that, where rates are moving towards high double digits, and price earnings multiples, or a market multiple that's 20 or 25, can move back down to single digits. So that puts a real damper on equity markets. There will still be many stocks that will perform in that environment, mostly commodity producers, precious metal miners, industrial companies that serve those industries. So there'll be places to make plenty of money in the next cycle following the bust. But the stock market as a whole, index funds as a whole, will face a very stiff headwind that's going to cause them to underperform and maybe even go negative during that time. So in that time, what does thrive, and we can go back to the late 70s and early 80s to compare a similar period, what does thrive in that are the precious metals, are the commodity producers, are the metal miners. So I really think, and energy, and those are kind of the areas that I think will be the big winners in the next cycle. And that's a lesson for all investors, is that every cycle, and I've been doing this 50 years, so I've seen many different economic cycles and market cycles that go along with those economic cycles. Each market cycle has a different leadership. So, this cycle, it's been the tech, it's been the growth areas that have been the leaders. The next cycle will be much more the value side of the equation, much more the cyclicals, much more the inflation hedge stocks. And the ones that will suffer will be a lot of the ones that were the leaders this time. So it causes investors to have to be a bit aware that it's not a straight line. It's not just keep doing what you do. And there are times when buy and hold, just put it in an index fund works. And there are times when that's a terrible strategy.
Now, as we look towards this melt up in the next, probably within this year, you're saying you've mentioned how there will be a narrative that will be very convincing. And I think one of the aspects of that narrative that's making gold and silver rise and also the stock market rise is that the Fed is going to be cutting interest rates. And that's, extremely bullish. It's great for the economy. Now, how do people, remember to not pay attention to the noise, but look at the big picture as you do when you're looking at these macro trends and not get caught up in this narrative that if they hold on to stocks during this bust, they could be incredibly hurt?
Yeah, I think you're right. The narrative that's going to help drive this is going to be, we've come through a tightening cycle, and now the Fed is beginning an easing cycle, or will be beginning an easing cycle. And it will be easy to buy into what will be the call of the day, the narrative of the day, which is this is the beginning of a new easing cycle. That means there's a long runway ahead. And they may be saying that right at the top of the secular bull market, because, if the Fed's just beginning to ease, usually easing cycles last, the tightening cycle lasted, a couple of years. The easing cycle might last 3, 4, 5 years or more. The problem is that's probably not the case. And frankly, there's things going on below the surface that suggest to me that, first of all, the Fed might come back and tighten right after they cut rates. They might say, well, look at the markets responded to us and gone straight up. We got to take some of these animal spirits away, and they could actually hike rates again and start the whole thing going the other way. Secondly, this is economic forecasting is not about, monthly numbers or, the last quarter's GDP. There's a lot going on below the surface that doesn't necessarily show up in all of that. So I believe below the surface, we certainly have a have-not economy that represents maybe 80% of people that are struggling to get by, that are struggling to meet their daily budgets. And then we have a 20% that are, gleeful here, saying my wealth just keeps going up. Housing, which had a great run, is showing signs of strain. Yes, it could have bounces along the way here in the spring if rates come down a bit. But, basically, I think we're seeing a secular top in housing, and that could start going the other way. Europe's not in good shape. The rest of the world, China's not in good shape. There's a lot of headwinds out there that can kind of cause that narrative about the Fed to be off. So I just caution people, psychology drives markets as much as fundamentals. And the psychology at the top, when we get there, we're not there. We're just beginning to move psychology from that bearish mode it was in for 2 years to where institutions are now beginning to buy into this being a bull market with legs. Give it time. That's what the next 3 to 6 months is about. In that time, it's going to be natural for investors to get more excited because they're driven by the up move in the market, by the momentum of the market, or as I say, the momentum of the tape. You have to guard against becoming so bullish at the exact wrong time, because as you're going up in the market, you're getting more bullish. And there's a point at which that maximum bullishness is also maximum stock market, and it goes the other way. History shows, and that's why I'm a contrarian, at market tops, you have the highest level of bulls. At market bottoms, you have the lowest level of bulls. That's why I was so bullish in October of 2022 when everybody else was bearish. You're going to see, I think, within the next 3 to 6 months, me turning very bearish at a time when everybody else is going to think I'm crazy doing so and tell me why I'm wrong. So you just have to understand market psychology, investor psychology, and not get caught up in that.
No, when it comes to the dollar, a lot of people looking at the markets obviously pay attention to what the dollar is doing. I know you've said that in the next couple months, we're going to see the dollar fall significantly, which I assume then would push these markets higher, just as you're expecting.
Yeah, I think the dollar has just this week finally finished that counter trend rally it's been in for a while. It was causing a lot of people to get more kind of jump on the bandwagon and say, oh, the dollar has more to go. There's going to be, might go to 109 or it might go to 110 or 108. We got up to 105 and change, but I think it's rolled over now. We'll find out. It's very early in that move if it is, but I continue to say we'll see the dollar down at 80 this year. And that's a long ways from where we are. So if the dollar goes down, that's very bullish for the precious metals, very bullish for the miners. It's bullish for the commodity sector as a whole, for sure. And I think that's what we're likely to just be we're just seeing now, just getting started.
And what do you see for the stability of the financial system, the banking sector, as we head into this melt up and then also go into the crash?
Yeah, I think actually from a stock market perspective, I think the financials are going to be one of the groups that outperform here in the melt up. It's going to be a broad rally, so a lot of things are going to do well. But it's not yet time to say that financials are a problem. But once we get to that that point of a top in the market and the kind of the beginning to worry about the downside of the economy. The financials, I think, are going to have some real trouble. Our banks here in the U.S. obviously took it on the chin in 2008-9. Many of them were close to failing, were technically failing without bailouts, and they were forced to get religion. We forced higher capital constraints on them. So our banks are in pretty good shape relative to the world. That doesn't mean they can withstand what I think is coming. Some of them won't. But I think the real problems are overseas. Europe's banks, Canada's banks, Australian banks, China certainly is a wild card. Japan's got, they've kind of had. They've been trying to hold their system together for quite a while here by following a pretty aggressive monetary policy of printing and buying up as many bonds as they could. If rates break out there as they look like they could, they got a long ways to go in terms of trying to rein in what they've done for the last several years, and that could really hit their financial system. So there's there's plenty of areas where I think the financial system is going to show that it's vulnerable. As I've said before, the bust means we'll probably see many large banks go under. Less so here, more so overseas. Our regional banks are dealing with a huge commercial real estate issue, among other things. So you're certainly going to see some bank failures here of one form or another. And we've got issues in the pension fund area, a lot of unfunded liabilities there. People in the pension area have chosen to diversify into private equity in a big way, thinking, well, that doesn't have the market volatility, so we're actually doing more conservative investing. I think it's quite the contrary. Leverage is what you don't want to have going into a bust. I think we're going to see problems in the pension area for sure. So there's a lot of areas where I think the flaws, will show up as the tide goes out. I think people have to just be somewhat cognizant that the good times may feel pretty good here for a few months, but don't get caught up in them.
All right. Well, David Hunter, we really appreciate your time today. Any last thoughts for our viewers? And if our viewers are interested in learning more, where can they find you?
Yeah, we didn't touch much on rates, but I will say I think rates, because there's been a lot of concern about rates here recently, because they've pushed back up. People have to remember the 10-year fell from 5% to 380. So all we did when it went from 380 back to 440 was basically a 50% retracement, which is a normal consolidation. And I suspect that consolidation's pretty much run its course. So as with the dollar, I think rates are rolling over here. I wouldn't be surprised to see rates heading for 3% soon. That's not what's on the street right now. Everybody's focused on some new breakout in inflation and economy getting stronger. We get these ebbs and flows in terms of, month-to-month readings, and the street kind of in their infinite wisdom of being traders and looking at every data point and extrapolating it, kind of go a little too far with it. It's possible we could have a few months where it goes the other way, but my sense is we're still seeing inflation trending down. The economy is still softening underneath the surface. Jobs that everybody wants to say are strong. A lot of the strength is in part-time. There's been no growth in full-time jobs. So all in all, I think, at worst, I think we're in a steady as she goes, not, heating up type situation. And actually probably more likely we're in what we saw for several months last year, a period of softening, which allows inflation to continue to move towards their 2% target. So I just wanted to get those thoughts in because we hadn't touched on that. But you can find me on Twitter every day. My handle is at Dave H. Contrarian. And I also put out a quarterly investment letter called the Contrarian Value Advisor that is offered by subscription, which means it comes with a cost. I get people, and you can find out about the details of the cost and what the letter entails by direct messaging me on Twitter or X, whatever you want to call it. I get people once in a while DMing me and say, "Yeah, sign me up for that newsletter." Well, it's not a freebie. I'll send you details in terms of what it is, and you can decide whether it's worth your while or not.
David, thank you so much for joining us today. As always, it'll be great to check back in with you in the next quarter. It should be a very interesting time ahead. So thank you so much for your time, and God bless.
Yeah, thanks, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 1st through April 8th, 2024, while supplies last. First, we feature 2023 1-ounce Silver Krugerrands at $3.10 over spot. We also have backdated 1/10-ounce gold Canadian maples at $35 over melt with a minimum order of 4. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.